Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will stay on the overall market sentiment, more specifically the risk sentiment, looking for some potential opportunities in the high betas versus the safe havens and vice versa, if we do get any massive flows from risk on and risk off. In this week, the main themes that we'll be watching out for would be further tensions or escalations between the US and China. Also watching out for any potential developments with regards to the proposal made by Germany and France with regards to the recovery fund. And then also, of course, keeping track of the overall virus statistics, any breakthroughs with regards to vaccines and antivirals, etc. So lots of things we need to focus on. Also keep in mind that on Monday we have a banking holiday in both the UK as well as the US. Thinner liquidity environment, so be careful out there. And also on Friday, we do have month-end flows or rebalancing taking place. That can always see some weird price action moves up and down. So a couple of things we need to pay attention to. Join me now to the video to see exactly how we're preparing for this week's events and hopefully trade them in this upcoming week as well. Taking a quick look at the overall market sentiment, it has been very resilient recently, especially after the mid-March market crash. Now, there's been plenty of ups and downs in the short term due to various positive and negative catalysts. On the positive side, we've had the biggest central bank and government stimulus programs announced in history, with the Fed announcing an unlimited QE program and already pushing its balance sheet to over $7 trillion US. Apart from that, the positive decelerating trend of new coronavirus cases in major European nations that started to ease their lockdown restrictions has also been another positive input for overall market sentiment. Looking at the charts below, we have Germany, Italy, Spain, as well as France. We can see after they started to ease their lockdown restrictions, we've had that steady downtrend in terms of new coronavirus cases. Now, that has seen as a positive. Also, the reopening of economies after the nationwide lockdowns is also giving some hope to markets, especially as the forward-looking data like flash PMIs are showing some rebound in initial May numbers. Now, we'll touch on that in a little bit more detail later on as well. Now, even though business activity remains significantly low, the data does point to some slight alleviation in terms of the rate of decline for output across the G4 economies. We can see that jump to the upside. Now, these PMI metrics are by no means good, for the lack of a better word, but they are showing some better than expected returns of activity, even though it's still colossally low. Now, apart from that, we've also seen some positive news regarding vaccines and antivirals for drugs like Gilead Sciences' remdesivir, as well as Moderna's RNA-1273. Now, the market's overly optimistic response to any type of positive vaccine or antiviral news just shows that the current crisis is very much a health crisis right now. Thus, until the real problem, which is the virus, is solved, things won't get back to normal, so to speak. Now, for all the market bears in the room, we've also had some negative catalysts as well. The hard data for quarter one and quarter two has just been absolutely horrendous. You know that markets are looking forward or forward looking when something like an NFP of negative 20.5 million in April in the US alone isn't really enough to move the market needle. Now, the recession has wiped out all the jobs created in the last decade in the US, which is just staggering numbers if you think about it. Now, even though most of that initial bad hard data has been priced in, arguably a lot of the transmission effects of that, all of those damages still needs to be fully realized by the markets. Now, going back to that flash PMI numbers, it's important to realize that the fusion indexes like PMIs were not really designed for environments where business activity goes to basically zero. So that means that even the slightest restart of economies after the lockdowns will show misleading V-shaped looking charts like this one. So just keep that in mind going forward. And also turning to something like volatility, yes, we have seen quite a massive downtrend across the board for cross-asset volatility, which has been a positive for markets. But keep in mind, a VIX that is still very close to 30 is still considered as a highly elevated level from a historical point of view, which still implies high amounts of uncertainty about the future. Apart from volatility, recent moves across global equities are also telling of the uncertainties, which basically remains intact and quite high. The above chart is an example of a comparison of some of the global equity indexes. Now we can see we have the S&P, the Dow Jones, the Nasdaq, DAX, Euro Stocks, ASX, the Nikkei 225 and the TSX, and we can see that across the board, global macro markets are moving more sideways recently. Obviously, apart from the Nasdaq due to its composition with names like Microsoft and Apple and Amazon has been outperforming everyone, but largely range-bound moves across global market equity markets are quite telling of the recent battle between that positive as well as negative catalyst in the market in terms of risk. Now, from a purely technical perspective, the highs and the lows of these recent ranges in the global equity markets will be an important consideration for both the bears as well as the bulls, and can create some great short-term risk-based trading opportunities with the right type of catalyst in mind. Then, just when the world thought things couldn't get any worse, we saw the biggest negative catalyst of all of them in the form of rising tensions between the US and China. Rhetoric has really been heating up between the two sides, which is making market participants a little bit uneasy right now. Now, the recent tension started with verbal attack from the US regarding the way China handled the virus. The US has not been alone. However, we've also had other countries like the Eurozone group as well as Australia calling for independent investigations into how China dealt with the virus. Now, apart from that, the other contentious issues such as technology sanctions on Huawei, US and Taiwan relations, and Hong Kong are also storming back into focus, and this poses the greatest short-term risk for any hopes of a sustained economic recovery as major economies emerge from the pandemic fallout. So there's certainly lots of positive as well as negative catalysts currently in play in the market that we need to be aware of. Then looking over to the baseline for this week's upcoming risk events. Now, economic data has largely taken a backseat recently as we had the backward-looking hard data. It has been bad, but it hasn't really been enough to move the needle because a lot of that has been priced in already. So it's safe to assume that with another light economic calendar, this week's upcoming focus points won't be on that. It'll be mostly on the geopolitics as well as the virus developments. Now, turning to geopolitics, there's basically two things we need to watch out for: US-China tensions, and then the EU recovery fund. Now, tensions between the US and China has quelled up recently again, and markets are braced for some potential escalation between the two sides after China committed to enact a national security law in Hong Kong. And after the news, the US administration said that they are looking to at possible economic penalties for China regarding that. Now, President Trump also commented on the matter last week, saying that the US will have react very strongly towards China if China pushes ahead with the legislation. So it seems that China has lit the fuse, so to speak, and now the market is waiting for a possible fallout this week. Now, across the Atlantic, of course, we had Germany and France proposing that 500 billion euro recovery fund. And even though the fund is believed by many to be a step in the right direction, there is some expectation that more frugal states, of course, like Austria, Sweden, Denmark, Netherlands, etc., will push back against the idea. So that's also a focus point. And then looking to virus developments, coming back to the real problem, of course, which is the global pandemic. This week, we need to keep our ears and eyes open in two specific areas regarding the virus, namely the first one, second wave infections, and then, of course, the treatment or vaccine breakthroughs. Now, markets reacted rather muted towards the possible second wave of infections in China, especially in the Rust Belt region, which has caused lockdown measures being reinstated for over 100 million people. That's quite significant, and this poses a question of the likelihood of a possible second wave of infections, especially in other countries that has also now started to ease lockdown restrictions like Europe and the US. Now, the massive run in risk assets on Monday from positive news about the Moderna vaccine shows how important it is for the real problem, which is the virus, to be fixed. And although a later report did pour some cold water on the claims made by Moderna, markets shook it off quite quickly, rather choosing to focus on the positive. So further developments this week in line with that type of virus news will be very important. And then also consider the fact that on Friday we might have some possible month-end flows. It is time for month-end rebalancing, and that can always see some weird price action in the market. So definitely something we just need to be aware of for Friday's session as well. Then looking over to the possible sentiment shifts, starting with the hawkish ones, focusing on US-China tensions, what to look for there. Currently, it's all been all talk but no action, right? So the US has threatened to retaliate against China regarding the Hong Kong legislation, but we are yet to see them take actual steps. Now, if the US comes out with more verbal threats, but don't take the fight to China with actual retaliation, that can be perceived as some as being more positive, and that can also see some positive moves in the markets this week. Looking at the EU recovery fund proposal, if we see unanimity with states like Austria, Netherlands, Sweden, Denmark broadly accepting that Franco-German proposal, that'll see alleviation from the fears that a second debt crisis is on the EU's doorstep, and that should be positive for the euro as well as global equities, which would obviously be a good trade in terms of high beta currencies versus the safe havens. Virus breakthroughs, last week's NIC's Fauci said that he was cautiously optimistic after reviewing the data released by Moderna regarding their vaccine, and he explained that the data still needs to be peer reviewed, but so far it is looking promising. So any further positive developments from Moderna's vaccine or any of the other 100 that is currently in developmental phase, that can also spark some fresh risk on rallies this week. So definitely something we need to pay attention to. Switching over to the dovish possibilities, also again US-China tensions. There are many retaliation tactics that the US has said they could use against China, whether that is against the Hong Kong legislation or not. Some of these include abandoning the trade deal, delisting Chinese companies from American stock exchanges, restructuring supply chains, further backlisting of Chinese companies like ZTE and Huawei, and of course removing Hong Kong's special trade privileges. So far, reaction from the market towards the tension has been muted as no actual action and retaliation has been taken. And if that changes this week from either side and we see that tit for tat escalation, that will really cause some problems for risk flows and can see some risk off flows that is very tradable in this upcoming week. Also, again, turning back to the EU Recovery Fund, the word of the week for the Eurozone is unanimity. The Recovery Fund requires all member states to agree, right? So that means that if we see any pushback from any of the 27 member states, especially the more frugal ones like Austria, Netherlands, Sweden, Denmark, that can put some pressure on the euro. And if they do push back, that should be one of the more negative inputs for the overall risk flows for equities as well as the euro in this week. So definitely something to keep in mind. And then in terms of virus breakthroughs, so far, the case numbers in countries that has reopened the economies are looking promising, especially like we saw in Europe. However, the second wave infections in places like China could see dovish sentiment shifts if they start to occur in other countries as well. Also, another point to consider is that the new epicenters around the world, like in places like South America and Africa, it's gone largely unnoticed so far by markets. And even though markets should be less sensitive to escalating numbers by now, the risk of uncontrollable spreading in less developed countries is also an important risk factor to keep in mind for this upcoming week. Then looking how we can potentially trade this risk sentiment shifts. As our attention turns to risk sentiment, we would look to pair typical risk sensitive currencies with each other in the case of a risk sentiment shift. So if we see strong risk of flows, we will expect that to be supportive for the safe havens like the Swiss franc, the Japanese yen, the US dollar. And we'd expect that to weigh on the high betas like the Aussie, the CAD, the Kiwi. And then, of course, if we have risk on flows, we'll expect that to be supportive for the high betas like the Aussie, CAD, Kiwi, and expect that to weigh on the safe havens like the Swiss franc, Japanese yen, and the US dollar. Now, the highest probability currency pairing would be to pair a safe haven against the high beta and vice versa, depending on the type of risk flows. Now, there are a couple of points to also consider, like individual factors that can influence the currencies this week. For example, any progress or breakdown, like we said with the EU Recovery Fund proposal, that'll be a very big input, an important one for the euro. So keep that in mind. Also keeping a very close eye on Australia for the Aussie. Australia and China also having a little bit of a political tussle recently. And if that escalates further, that's obviously a very big risk for the Australian economy and will affect the Aussie dollar. In the same way, keep track of any potential other influential factors like oil prices affecting the Canadian dollar or S&P intervention affecting the Swiss franc. Remember that these recommendations are based on the current fundamental bias and can change during the week, so make sure to reevaluate whether the short-term sentiment is still valid for these currencies before you take any trades. Now, looking at possible economic events to trade into, as the main focus is on risk sentiment, we know that is something that can change very quickly. Thus, we won't be interested in trading into any of the upcoming risk events this week, but we'll look to changes in the risk sentiment following some of these events for the best possible trading opportunities.